were given to you by the GoToMeeting email. In order to reduce background noise, please be aware that all participant lines are muted throughout the webinar until the Q&A section at the end of the webinar. The presenter will respond to all questions at the end of the webinar. Please note that today's program is being recorded. It is now my pleasure to introduce our presenter, Mr. Renon Kent. Mr. Kent is the Managing Director and Head of Houlihan Lokey's Testing, Inspection, and Certification Practice. During his career as an investment banker, he has advised many leading companies in all facets of their business, including M&A, debt and equity recapitalizations, traditional debt equity, and equity-linked financings. Over the course of his tenure at the firm, he has been involved in a wide range of domestic and cross-border transactions across a variety of end markets, including aerospace and defense, power and energy, general industrial, environmental, transportation, food, and healthcare. Mr. Kent earned a BA magna cum laude from Brandeis University and an MBA from the Anderson School at UCLA. Ladies and gentlemen, please welcome Mr. Renon Kent.
Thank you, Jessica. Thank you very much, and good afternoon or good morning to everyone, depending on where you are. My name is Renon Kent, and as Jessica mentioned, I head the Testing, Inspection, and Certification Practice here at Houlihan Lokey. For those of you who are not familiar with Houlihan, I have included a few slides in the appendix on pages 18 through 20, providing a brief overview of who we are, our capabilities, and the relevant experience we have in the testing sector. Just to note, we are the largest investment bank in the world focused on the middle market. Anyway, today I plan to provide a brief overview of the current market trends, overall M&A activity, and an update of what has been happening in the testing sector over the recent past. As Jessica mentioned, please email in your questions, and pending timing, I will try and address your questions at the end of the discussion. If I do not get to your questions, my contact information is in the back of the presentation on page 16, and you should feel free to reach out to me directly. Please turn to slide 4. It really has been a wild start to 2016 with tremendous market volatility across the globe. It's remarkable that the S&P has actually bounced back and is now effectively flat from where it closed at the end of 15. We are still off from the record highs, but the market seemed to have stabilized, at least for the time being, albeit I'm sure the fact that I just said that, we're going to see some real volatility over the coming weeks. Although remarks by the Fed last month indicated that further interest rate hikes may be put on hold, as you all probably know, the Fed is meeting over the next couple of days. They're not likely to raise rates this week, but the Fed governors believe that the steady growth of the domestic economy, despite the volatility of the financial markets and the weakness in some other overseas countries, is strengthening, and higher rates are going to be necessary to maintain inflation. So it seems increasingly clear that the Fed's plan is to spend 2016 gradually raising its benchmark interest rates. They've been delayed, but not derailed. So part of the volatility described and some of the things that you see on this page, it's been driven by commodity prices, experiencing tremendous downward pressures. And some of you on the phone may have experienced some of that in your own businesses, in addition to slowing growth in China. In fact, here at Houlihan, we have a very large restructuring practice, and they are extremely active with respect to energy and oil and gas. In the U.S., my view, and I think the prevailing view, is the economy is expected to continue on its path of gradual economic improvements, albeit there's uncertainty as it relates to the political environment. Solid growth in job creations are expected as lower crude prices help spur consumption. Overall fundamentals are solid despite the weakness in the energy sector. Turning to page 5, you can see on the top 2 charts, and this slide deals with what's been going on in the M&A world in the U.S. You can see the overall M&A trends in the U.S. In 2015 was a record year in terms of overall transactions value, with over $2 trillion worth of deals announced. Total volume of deals, you can see on the top right, declined for the first time since 2009, although still at pretty good levels. There were some very large announced strategic mergers that helped drive the overall value of deal flow. There was Pfizer's almost $200 billion acquisition of Allergen, the InBev Miller transaction, $120 billion, Shell and BG, Dow DuPont, Heinz and Kraft. Those are all north of $50 billion. There are also a few energy deals in the top 10. But a recurring theme, and a theme that you'll hear from me a few times today, healthcare, pharma, and food really dominated the top 10 deals. You can see on the lower left where valuation multiples have trended over the last few years. The upward trend continued in 2015 to record valuation levels. Mind you, this is not weighted by size, but rather by overall values. And as I will show you later on in the presentation at the end, and I know it seems somewhat obvious, but larger deals tend to trade for higher multiples, benefiting from scale and diversification. Finally, the bottom right chart demonstrates another reason for high valuations and solid overall deal flow. Leverage, or the amount of debt put on a company when purchased by a private equity firm, was near record levels, with average leverage well north of 5 times debt to EBITDA. The availability of cheap capital continues to propel a very active M&A environment. So taking a step back in the real world, and what have I seen over the last few months? It's interesting. As 2016 has started, it's a bit of a tale of two cities. Most folks, especially private equity firms, will tell you that there are few high-quality assets available on the market, so not a lot of good deal flow. When a great asset is actually put on the market, it warrants tremendous interest, still very high leverage and high multiples. But for a marginal asset, not a bad company, but just not a oceanfront property, as I would put it, maybe one that has a little bit of hair on it, they are much more difficult to get done. They are taking a lot longer to get done. There are lower leverage amounts and lower values. So it does seem obvious, but over the last couple years, deals that weren't primo deals were still getting done. We're still getting done at high multiples, especially given the availability of leverage over the last few years. So there's been a little bit of a disconnect in the deal world. If you flip to page six, and this will be my final comment about the macro environment, and then I'll turn to the testing world. You can actually see the private equity. Page 6 highlights the private equity activity in the market. The line highlights the somewhat slowdown in activity at the end of 2015, still at good levels and well higher than where activity was in the 2009 timeframe. But the main takeaway is that bullet point at the top. Traditional private equity firms have over $460 billion, and that's unlevered, so it's assuming no leverage, burning a hole in their pocket. They need to deploy their capital. That's how they make their living. And the continued availability of leverage will continue, or should continue, to drive deal activity in the middle market for the foreseeable future. So let's move on to the testing market and page 7, and I'll provide you with some updated trends over the next few pages. So page 7 highlights why the testing and inspection and certification sector, the TIC sector, remains an attractive market for many potential investors and business owners. You have all probably seen many of these drivers in your own business. I continue to see growth in outsourcing in certain end markets like aerospace, like the utility market, and we all know where regulations have gone and where they will most likely continue to go. A continued focus on safety and quality and supply chain complexity are just a few of the other key drivers driving momentum in the sector. In addition to the demand drivers on page 7, as it relates specifically to lab-based businesses, which I know is a little bit more relevant given the audience on the phone, there is a perception in the market, and I think it's more than just a perception, that there are real significant barriers to entry, as highlighted on page 8, for many lab-based businesses. Labs are considered higher up the value chain of testing companies given some of these barriers, the need for accreditations, investment in capital, IP, multiple locations, economies of scale, while still ultimately dependent on end markets, free cash flow, and what you are actually testing. Historically, lab-based businesses have traded and should continue to trade at a premium to field-based testing businesses for many of the reasons described on this page. Anecdotally, I will tell you, food and food testing and safety remains a very popular theme in the market today, and you'll see it a little bit further on, highlighted by both large corporates looking to further grow and diversify their food testing businesses and private equity firms. And you would be surprised at how many private equity firms are interested in that sector, and they've actually spent a considerable amount of time and money developing investment theses around the food space and how they could play, how they could benefit from the dynamic changes going on in the food industry, given what's been going on with FSMA. Moving on to valuation. So page 9 highlights the 10-year valuation trends of the publicly traded testing companies, and I've listed the index at the bottom of the page in terms of who is included in that index. While still trading at elevated levels, if you look all the way to the right, the testing index is trading at 10.7 times enterprise value to trailing EBITDA. The TIC sector was trading at the end of the year below its long-term 10-year average of a little bit north of 12 times. If you fast forwarded to today, it's not shown on this page, the market is back up to a little bit north of 11 times. So it's slightly below its 10-year average. But I think the key takeaway here is the testing index, the testing companies historically outperform the broader market. And you can see even during the recession, and it's highlighted in a box at the middle of that page on the top, these companies were still trading at 9 to 10 times, which, given what was going on in the overall market at that time, is still pretty remarkable. But I guess the question is, well, what happened in 2015, and why did the sector trade down over the last year? The simple answer is commodity prices, and to a certain extent, mining exposure. And if you look at the specifics with many of these companies, much investment was made in oil and gas by the large corporates over the last 5 years. They made large acquisitions. They paid aggressive prices. Despite the market trading off where it has historically traded, you can see on page 10 that over the 10-year period, and if you look at that top chart, that index, as I mentioned earlier, it outperforms its peers by quite a lot. So that TIC index is at 145% return over a 10-year period versus these other indexes that you are used to seeing. All the way over to the right, in the circle, you can see the monthly 2015 and 16 charts. You can see the volatility that the index has experienced over the last year. And it's interesting to see that these businesses have become a lot more correlated, much more correlated with the broader market. But as I mentioned earlier, despite the volatility, It really is only off 10% from its 10-year highs, 10-year averages. Still trades at a premium and remains a sector that is expected to experience real growth over the next few years. I've highlighted some key trends that are highlighted by analysts on Wall Street, and they continue to be main topics of discussions and drivers of interest in the sector. As I mentioned earlier, all things food. I'm currently in the market today with a food testing business, and I'm experiencing really heightened interest in the asset compared to some other deals. I would tell you QA certification, traceability and supply chain management across industries, so not just limited to food, but industrial end markets, consumer end markets, and driven by some of the themes I previously mentioned, has also been a real area of focus. And finally, there's been some activity, especially we've seen it with Eurofins on the life sciences side, and that continues to be an area of focus and investment. On page 11 provides a backdrop for how the big three testing companies, SGS, BV, and Intertek, have performed of late. I mean, they're really viewed as bellwethers in the industry. You can see in the top left their stock performance over the last year. All but BV have effectively been flat, and as noted below, and as you might know, Bureau Veritas having a more concentration in industrial end markets have underperformed vis-a-vis some of the other players in the market. You can see down below the changes in perspective that have occurred over the last year. The chart below demonstrates, for example, I'll give you an example here, where SGS expected revenue to be as they looked forward in early 2015 and where they thought 2016 would end up. And then we then looked at what the expected growth for this year was, just looking back a few weeks ago as these companies put out their budgets. And you can see that SGS, for example, revised their growth upwards by 2.7%. Both SGS and Intertek have a much more positive outlook, while BV's outlook has changed to the negative, and again, given them a much heavier industrial and market focus. Also note here the projected organic growth rates. It's interesting because I think when I gave this a presentation like this a couple of years ago to the group, the organic growth rates, the historical organic growth rates for these businesses were significantly higher. They typically were mid-single-digit organic growers. But given some of the upheaval in the markets and a little bit more maturity in some of the businesses that these companies have acquired, they are now in that 1 to 3% organic range. And I'm going to get back to that point in a little bit, because that slower organic growth rate continues to and will continue to be a driver for consolidation and M&A activity by many of the larger players. The other recurring theme that is noted with all three of these companies is that food and life sciences continue to be areas that are either contributors to the growth of the businesses or expect to be contributors to the growth of the businesses. Page 12 drills down a bit deeper into the performance of the major testing players and the stock performance. You can see in the top left, Eurofins continues to outperform, driven by aggressive acquisition growth, solid organic growth, and a focus on growing end markets. On the top right of the page demonstrates how certain businesses that have a high concentration of energy have been more negatively impacted by the commodity price pressures. And you can see ALS and APLUS are highly correlated to the price of oil. It's also interesting to see in the bottom right where the major players have been focusing their M&A activity over the past year. No, not in energy. If you looked at this list a few years ago, it would be dominated by deals in the energy space. But these businesses have clearly, the large players have clearly not slowed down their M&A machines. On page 13, despite some of the market headwinds described, this sector remains an attractive area for investment and continued consolidation. There are some great structural dynamics helping to drive the activity. There are very large corporates that we all know, and I've highlighted some in the sector, whose underlying organic growth rates have slowed. They have higher growth expectations that they've conveyed to the street, and the only way that they're going to continue to produce the expected results is by continuing to feed their M&A machines. Most of the large tech players are serial acquirers. They're looking to take advantage of many of the key drivers on this page, effectively wanting to be a one-stop shop for their customers, and also to internally diversify both their services and their geographic mix. Layered over the corporate need for acquisitions, private equity has emerged as a very viable and aggressive purchaser of tech businesses, and have actually been quite aggressive in certain circumstances. Private equity is attracted to the cash flow characteristics of these businesses, the high cash flow characteristics of these businesses, and the barriers to entry I previously mentioned, and really the high fragmentation in the market. So they view an opportunity to roll up certain end markets within the testing space. A little bit more detail on page 14 on some of the more notable transactions over the recent past. And it demonstrates the M&A activity over the last few years. And what I also did is I broke down the average multiples paid over that time period overall between strategic acquirers and then financial or private equity firms. What's interesting is if you look at 2015, financial groups paid more on average than strategic groups. Again, this is for just deals that are highlighted on this page, so it doesn't include all deals. But it's a little bit counterintuitive to what a lot of people typically think. They say, oh, these big testing companies, they've got huge balance sheets, they can pay whatever, they trade at big multiples, so they can afford to pay more than a private equity firm. But going back to some of the things I mentioned earlier, the amount of leverage, the amount of capital held by private equity, you're seeing them be increasingly aggressive in the sector. And you can see also over time that they've been aggressive and paid pretty good prices. Now, part of what pushed the multiples higher for the private equity firms in 2015 is you can see on the bottom right of the chart the last two deals that were announced in December, two of the largest deals ever in the testing space, and they are also at very high multiples. KKR purchased LGC out of the UK, and while not listed here, that deal traded for over 14 times. And that is, that's more of a food and life sciences play. And then 3i sold Element Materials to Bridgepoint, to another private equity firm in the UK. Element, as some of you may know, is a materials testing and product qualification business focused on the aerospace end markets as well as oil and gas and transportation. For the most part, a lab-based business. It went for over 12 times. It was a business that has experienced very good organic growth as well as acquisition growth over the 5-year hold period by 3i. And it was a very hotly contested auction, and you can see where ultimately the value of the business and the multiple traded. So again, both of these deals highlight private equity interest in the sector and their ability to pay higher prices than the corporates. You'll note that also during the course of the year, Intertek bought PSI. That was more of a play on the construction cycle. Team purchased QualSpec, which is a non-destructive testing business, really for the downstream refinery markets. So there were a number of larger transactions that occurred during the course of 2015 all of them at pretty good multiples. Finally, turning to page 15. You might wonder why I have this page here, but really, business owners always ask me, what are their businesses worth? And obviously, absent reviewing a company's growth plan and the financial results, it's hard for me to pull to answer that question and to pull a number out of that. But what I try to do here is break down on page 15 where deals in this sector have traded, and note, not all of these are lab-based businesses, broken down by size, and it's based on public information or industry sources. So what is clear is that there is a delineation in value based on size, and I mentioned this earlier. Size matters with respect to value. It's not to say that it matters all the time, and it's not to say that a smaller business can't trade at a big multiple or a big company can't trade at a smaller price. Just on average, if you are a smaller company, you should expect a lower multiple. In fact, if you are less than a $5 million EBITDA business, you could see valuations in the low to mid single digits compared to around 10 times for larger companies. Again, it's not an exact science, and you can see from this page, the number of data points that we have. I wouldn't say that this is a large sample size, but it does correlate somewhat, and you can see the correlation on the left side of the page. And the way that it was broken down for transactions over 350 million, transactions between 100 and 350 million, and transactions that were less than 100 million. So again, you have data points that are all over the place, but again, on average, bigger deals, bigger multiples, smaller deals, smaller multiples. And again, lots of other factors to consider, and markets, growth, management, the opportunities, backlog, a lot of other things that go into how a business is, how a company should be valued and what it is worth. But just on the surface, as you're thinking about your own businesses, and as you're trying to think about, all right, if I were to sell my business today, where do I think it's worth? Everybody thinks the testing sector, everybody's going to trade at 10 times. It doesn't always happen that way. But still, still an attractive end market. So overall, key takeaway, again, not to leave this on a downer, you continue to operate in a very attractive sector. While not without its challenges brought on by external market forces, there's going to be continued growth, both organically and inorganically, in this sector. M&A activity is going to continue to push values, and hopefully you all will benefit from these trends. And that is the end of my prepared remarks.
Okay, I will go ahead and open up the microphones. Does anyone have any questions for Mr. Kent? Any questions at all? Okay. Well, it does not look like we have any last questions. So thank you all for your participation today. Thank you, Mr. Kent, for your presentation. And we look forward to you all joining us on our next ACIL webinar.
Thanks very much.
Thank you.